Hey guys, what is going on? Happy Friday and welcome to another edition of Financial Fitness Friday. Today we're going to be talking about the quarter 1 2020, quarter 1 2024 recap and the quarter 2 2024 market outlook. I'm Ron Sneller. Thanks for joining me. I don't want to waste any of your time. Let's dive right into it, guys. All right. So listen, stocks continued their upward trajectory in early 2024. The S&P 500 eclipsed the all-time nominal closing high that was last set way back on the first trading day of January 2022. So it's been over 2 years, right? Now, notably, the first quarter of 2024 saw a significant shift in investor sentiment as investors now only expect 3 interest rate cuts this year, as opposed to the 6 interest rate cuts that they were expecting at the beginning of the year. Now, this change in expectations came as inflation progress has slowed down, and inflation's proved to be a little stickier than we first expected. Okay. The US economy, it's also continued to expand and be really resilient despite these higher interest rates. And all of those things kind of combined together, it really signals the need for fewer rate cuts. So today's video, we're going to recap the first quarter. We're going to discuss the stock market's strong start to 2024, and then also look ahead to the second quarter. At the time of filming this, it's April 12th, so we're kind of a couple weeks in, right? But you see the graphic on your screen right there. The stock market is off to a very strong start this year, with the S&P 500 index rising during the first quarter. This chart graphs the price of the S&P 500 index from the end of 2021. Now, the yellow dots that you see, those mark a day where the S&P 500 closed at a new all-time record high. On the left side of the chart there, you see one single yellow dot. That was the previous all-time high set on January 3rd, 2022. Shortly after, however, the Federal Reserve started its aggressive interest rate hikes as inflation spiked to a 40-year high. Now, what the chart shows here in 2022 is that stock market sell-off as investors feared that higher interest rates would really slow down the economy. So the January 2022 all-time closing high, it held throughout the rest of 2022 and it held throughout all of 2023, but it's already been eclipsed multiple times here in 2024. So after trading below its prior all-time high for just over 2 years, the S&P 500 has set multiple new all-time closing highs this year. So the yellow dots on the far right side of the chart, that mark all of these different times that the S&P closed at new highs, and it shows that the S&P 500's steady climb higher so far in 2024. Let's talk about inflation. Inflation was on a steady downward trend heading into this year, and the market expected it to continue moving significantly lower. However, recent data is causing investors to rethink that assumption. This chart that you see on your screen here, it graphs the year-over-year change in the CPI, or it's a consumer price index, which measures the change of price for a basket of goods. Okay. Now, this chart shows the inflation spike in 2021 and in early 2022, followed by a period of easing inflation during the past 2 years, largely as a result of the Federal Reserve raising interest rates. However, the yellow box shows that the pace of inflation progress has slowed recently. While inflation is still drifting slightly lower, it's not falling as quickly as investors want or as the Fed wants. So the question now is whether the slowing progress is the start of a new trend, or is it simply just a temporary break in the current trend? Seasonality may be contributing to the slowdown, as inflation does tend to be higher earlier on in the year than it does later in the year. So the question is the early 2024 rise the result of previously agreed upon contractual price increases, or does it hit at something more underneath the surface? Well, what does Jerome Powell have to say? So Jerome Powell is the chairman of the Federal Reserve. He believes that this early 2024 inflation bump is simply seasonal and short-term in nature. Although this is the same guy and the same team who, back in 2021 and 2022 told us that inflation was transitory. So who knows, right? The market is less certain. The market's more divided. The chart here also demonstrates that getting back to the Fed's 2% inflation target is going to be a very bumpy and uneven ride. Okay. This disinflation process, or the slowing of inflation, it's not going to be a straight line, guys. The latest risk is rising oil prices, with the price of a regular gallon of gasoline jumping more than 20% in the first quarter alone. Now, overall, falling energy prices helped to ease inflation pressures during the last 2 years, but now there's the question about whether that trend can continue with gas prices on the rise. One of the big debates heading into 2024 was how many times the Federal Reserve would cut interest rates. This chart tracks the market's rate cut forecast. So if you look on the left-hand side there, this is looking back to the start of Q4 2023. Back then, the market expected the Federal Reserve to cut interest rates 75 basis points this year. But by the end of December, the market's rate cut forecast for the entirety of 2024 had doubled, went from 75 basis points to 1.5. Okay, 1.5%. Now, based on a typical rate cut increment of just 25 basis points, so investors came into this year expecting that the Fed was going to cut interest rates 6 times, quarter point each, for a total of 1.5% interest rate reduction this year. In contrast, the Federal Reserve itself, with its own forecast, it never bought into any of that. The Fed only expected 3 interest rate cuts at the start of the year, or half of what the market was expecting. And there was this debate over whose interest rate cut forecast was going to be more accurate. As of the end of quarter one, it looks like the central bank won out. It looks like the Fed's forecast appears to be more accurate. So investors have kind of fallen in line. Now investors only expect 3 interest rate cuts this year as well. So why do investors expect fewer interest rate cuts this year than what they were expecting just 3 or 4 months ago? One reason is that inflation progress is slowing. So if we raise rates, inflation could potentially take off again. And we don't want that, right? Another reason is that the US economy, it remains resilient despite higher rates. I mean, a lot of times the reason that they're cutting rates is because the economy is slowing down, or maybe they fear it's slipping into a recession. But with the economy being so resilient, there's really no reason to cut rates significantly now. We're going to take a look at the 3 different data points here that are going to underscore this economic resilience. First up, let's talk about housing. Okay, this chart graphs the number of new homes for sale by stage of construction, not started, under construction, and completed. So the chart shows home construction activity is at levels not seen since before the 2008 financial crisis. And this is despite the average 30-year fixed rate mortgage sitting near a 15-year high of 7%. Absolutely incredible. Next up, let's talk about consumer sentiment. This chart shows consumer sentiment rose to a 2.5-year high in March after setting a record low in June of 2022. Now, if you remember, that's when inflation spiked to its highest. It was 9.1% in June of 2022. So multiple factors are contributing to the improved consumer sentiment, including a tight labor market, rising stock prices, and rising home values, expectations for a continued decline in inflation, and this solid economic backdrop. Let's take a look at this. Transitioning here, this third chart tracks the price of a barrel of West Texas Intermediate crude. Crude oil prices have risen from approximately $70 per barrel at the start of the year to $83 per barrel at the end of quarter one. This is an increase, guys, of roughly 18.5%. Oil is a cyclical commodity, so rising oil prices suggest demand is strong, and that may hint at the underlying strength of the U.S. economy. Let's take a look at some equity market recap now. The opening section discussed the stock market's strong start to the year, following an impressive recovery in quarter four, where the S&P 500, it kind of went to a lull there end of September and into October, but then it bounced up 11.6% in quarter four to have a strong finish to 2023. And then to start 2024, first quarter, the S&P 500 returned an additional 10.4%. So great news there. What about small caps? Small cap stocks underperformed during the quarter as the Russell 2000 index returned 5%. 10 of the 11 S&P 500 sectors actually posted gains, with the cyclical sectors outperforming their more defensive counterparts. The energy, financial, and industrial sectors each outperformed the broader S&P 500 index, while real estate, utilities, and consumer staple sectors underperformed as the stock market rallied. Now, international stocks underperformed US stocks for a fourth consecutive quarter during quarter one. Over the past 12 months, the MSCI EAFE index of developed market stocks, they returned 14.8%, or roughly half of the S&P 500's 29.4% return. The MSCI emerging market index has returned only 6.8%, or approximately one-fourth of the S&P 500. Now, there's a few themes that explain why international stocks continue to underperform. First, international stock market indices lack the exposure to leading AI companies like Microsoft, Nvidia, and Supermicro Computer. Second, as discussed previously, the US economy continues to expand despite higher rates, and there's many foreign countries that are in recession right now. In contrast, some countries and regions outside of the US, they're already feeling the impact of their higher rates as they've kind of slipped into a recession. So investors have been attracted to the US for both its AI exposure, but also its real relative economic strength. Let's talk about the credit market. Now, while stocks started the year off with strong gains, bonds traded lower during quarter one. The losses came as investors realized that the continued resilience of the US economy meant that the Federal Reserve may not need to cut interest rates as much as previously expected, and that caused bond yields to rise. Now, the price of bonds are inversely proportional to yields. So as yields go up, bond prices come down. The Bloomberg US Bond Aggregate Index, which tracks a broad index of investment grade rated bonds, posted a total return of negative 0.7%. Now, it doesn't seem like a lot of loss. I mean, it's a fraction of 1%, but it was a sharp reversal from quarter four when the index posted its first quarterly gain since Q1 of 2023 and the biggest quarterly gain since 1989. Okay. How about corporate bonds? In the corporate bond category, investment grade corporate bonds underperformed high yield bonds during quarter one. Over the past 12 months, high yield corporates have generated a total return of 8.8%, which does factor in the interest payments received. Investment grade corporate bonds generated 3.5% total return over the same period. Now, the high yield bond universe continues to benefit from multiple themes. First, the group yields 7.83% at the end of quarter one, which is 2.45% higher than investment grade bonds. This extra yield helps boost the high yield's total returns. And second, as we've discussed throughout the video today, the US economy has remained resilient despite higher interest rates. The big investment themes were mostly unchanged during the first quarter. Stocks continue to trade higher, and the US economy remained in expansion mode. While the market now expects fewer interest rate cuts this year, the primary reason is that investors and the Fed believe that the economy can handle the higher interest rates. Economic theory, however, suggests that higher interest rates should slow economic activity as the cost of capital increases. But the current data is telling us a different story, right? Like this cycle, it's just been different. Home construction activity is the strongest since before 2008. Consumer sentiment recently hit a 2.5-year high. Unemployment remains below 4%. It's difficult to overstate the uniqueness of this economic cycle. I mean, there was unprecedented fiscal and monetary stimulus in 2020 and 2021 during the pandemic, and then followed by a rapid rise in inflation and then a rapid rise in interest rates to try to tame that inflation in 2022 and 2023. I mean, after all, inflation reached a level not seen since the 1970s. In the housing market, many homeowners have been locked into low mortgage rates during these past few years. So the rising interest rates had limited impact on them because they were already locked into the lower rates. Now, the labor market remains relatively tight after 5 million workers left the labor force during the pandemic and didn't return. That's something unprecedented. We've never seen that before. So these themes, they won't reverse quickly, and it will have long-lasting impacts, which both the Federal Reserve and the markets must try to navigate. Guys, here at Brookstone Capital Management and Sneller Financial, we'll continue to monitor the financial markets and the economy, provide timely updates to you, and adjust portfolios as needed. Thank you guys so much for tuning in. This is Ron Sneller, and this has been your quarter one market update.